So in today's video we're going to take a look at the PEG ratio. For many investors, an improvement on a standard PE ratio and a great way to work out whether a share is cheap or expensive. It's not perfect, no single ratio is, but we'll be taking a look today at why some investors consider it to be stronger than a PE ratio, how you calculate it, and also some of the things to bear in mind that might suggest it's not perfect in all circumstances. So, what is PEG? Well, it stands for PE to earnings growth ratio. So, it uses the PE ratio and takes it one step further. Now, PE ratios are one way of telling whether a share is cheap or expensive. It's the relationship between the current share price and 1 year's earnings per share. Now in this video we're not going to spend a lot of time on either of those two concepts, and that's for one reason. There are two other videos in this series which deal with them. So for anyone who's not sure about PE ratios, take a look at my video talking all about PE ratios. For anyone not sure about earnings per share, have a look at my video on earnings per share. And for anyone not sure about earnings at all, there is a video called What is Profit? So, I'm going to take for granted that most people watching this video will understand a little bit about earnings per share and a little bit about the PE ratio. Okay, so what is this thing, the PEG? Well, PE ratios are fine up to a point. A basic plain vanilla PE ratio is the current share price over the latest earnings per share figure. This is normally last year's earnings per share figure, although in fairness you can look 1 year forward and make an estimate, but essentially it says, you know, if the share price is 20 times 1 year's earnings per share, then you're going to wait about 20 years to get your money back if earnings per share doesn't change. And such as it is, PE ratios are quite commonly quoted and quite widely used. So what's the problem? Why can't you just say, well, if I can calculate a PE ratio of say 20, I can then do some comparisons and work out whether that's cheap or expensive relative to other shares and so on. Well, there are problems with PE ratios. How useful is that number? Number one, it's quite difficult to use PE ratios to compare firms in different sectors. Different sectors have different PE ratios. Utility companies, for example, typically have fairly low PE ratios. Technology companies and telecoms have high PE ratios. So cross-sector comparisons can be quite difficult because you'd always expect a telecoms firm to have a higher PE, all other things being equal, than a utility company. That's a given. So really, that in itself doesn't tell you much about which one you should buy, if either of them. So there's one drawback of PE ratios. Secondly, PE ratios really give you little indication about earnings growth. I mean, saying I would expect earnings per share to increase if I'm buying a company with a high PE ratio is all very well, but will it? And basically PE ratios are fairly static, particularly where earnings per share is taken for the last 12 months. Really, you're just looking at the past as a guide to the future. So a couple of fairly big criticisms of PE ratios there. Other criticisms, this tells you nothing about the size of the profits you'll expect to earn. Doesn't tell you much about dividends either. And also, it doesn't really tell you whether this firm can ever turn earnings into hard cash. So, for a number of reasons, some investors say, well, PE ratios are an okay starting point, but they've got limitations. So the PEG goes a step further. Now the PEG ratio is built on one key assumption. It is built on the assumption that the reason you buy a share is because you expect to squeeze future earnings out of it. In other words, today's share price is simply future earnings lumped together and discounted back for the fact that there's a thing called time value of money. So a pound received in 20 years is worth less than a pound now, thanks to inflation. So essentially, a share price represents a string of future earnings. If you're not sure about that, think about a property. In theory, a house is only worth the the future rental income you can squeeze from it. Otherwise, what's its value? So, shares are viewed the same way by fans of the PEG ratio. And as such, the PEG ratio goes a step further than the PE ratio. A PEG says, actually, what we really want to get a handle on is future earnings growth, because that really is the reason to buy a share. So the PEG ratio is the relationship between the PE ratio and the firm's earnings growth rate. And it gives you a number, just like the PE ratio. So you get a number out, like 1, for example. Okay, so how does that work? Well, let's say that I have a firm with a PE of 10. I also know that earnings per share are 10p now and are expected to be 12p next year. That's a forecast. So, just looking at those 2 years, I could say, well, the earnings growth rate is simply how I get from there to there. Well, that's 2p over 10p, that's 20%. So the expected earnings growth rate is 20%. And therefore, for this company, with just 2 numbers, the PEG is 10 over that earnings growth rate of 20, and that's 0.5. So mechanically, it's the PE ratio over the expected earnings growth rate. Now, in fairness, to just look 1 year ahead is a little unambitious. A lot of PEGs are calculated by taking an average of the expected earnings growth rate over 5 years. Straight away, of course, you've got a problem, which is how do you know what earnings are going to be over 5 years? And the answer is you need a forecast. Okay, so if I can crunch out an earnings growth rate and I can get to a PEG ratio of 0.5, so what? What does that tell me? Well, fans of the PEG ratio would say that what that reveals is that the share is cheap. In other words, here's a rough summary of how to use it. Basically, if the PEG ratio is 1, then the share is fairly priced. So for example, if the PE ratio is 10 and the earnings growth rate is 10%, that mechanically will give you an answer of 1. And that would suggest to PEG fans a fair price. In other words, all shares will tend towards a price to earnings growth ratio of 1. Logic: the PE ratio and the earnings growth rate are in kilter. In other words, a PE ratio of 10 suggests an earnings growth rate of around 10%. Okay, so if it's not 1, what's my conclusion? If a PEG is less than 1, you buy. If the PEG is above 1, you sell. Very crudely. That's the conclusion that PEG fans would draw. Below a half, strong buy. More than 2, strong sell. In other words, where the PEG is less than 1, and just now it was 0.5, in effect what we're saying is you, in theory, can pick up future earnings growth for less than it's worth by buying the share. So why wouldn't you? And equally, if the PEG ratio is well over 1, you're paying too much by buying the share at the current price for future earnings growth. So basically, by combining the PE ratio with an earnings growth forecast, we can come up with a conclusion about whether the share is cheap or expensive. In other words, we've got a step further on, if you like, than just looking at a pure PE ratio. Now, if investing was that simple, I wouldn't be standing here and you wouldn't be sat there. So clearly, this can't be perfect. It cannot be as simple as I screen stocks on this basis and I'm guaranteed to make a fortune. So what are the problems with this thing, the PEG ratio? And there are 2 or 3, let's say. Number 1, it's based on earnings forecasts. And earnings forecasts prepared by analysts working for banks are notoriously inaccurate. So you need to be fairly confident that the earnings growth forecast that went into the bottom of the formula is in some way meaningful. So the first thing to do is to challenge the assumption. Is it realistic to expect a firm to grow earnings at 25% a year for the next 5 years? And usually in the technology sector, you get some crazy valuations, and really you need to ask some hard questions about whether the earnings growth rate is in any way realistic. So that's the first problem. Number 2, like a PE ratio, this ratio tells you nothing about dividends. Really it works best on low dividend yield stocks. And for anyone not sure about dividend yields, take a look at my video on that topic. Really, if you're a dividend investor and that's your priority, PEG ratios are frankly of limited use. Linked to that point, PEGs tell you nothing about cash flow. Okay, can the firm turn this earnings growth into hard cash? And also, of course, we're making a big assumption that share price investment is driven by future earnings growth. That's not true in all sectors. For example, in the investment trust sector or the property investment sector, book values of assets held on the balance sheet matter more than earnings growth. So in those sort of sectors, you'd use something like a price to book ratio, probably ahead of something like a PEG or a PE. So the ratio needs to fit the sector. And finally, PEG ratios like PE ratios are pretty useless if a firm is loss-making. But then, if a firm is loss-making consistently, it is pretty useless. Essentially, why would you buy into a firm in any sector that's currently making losses? Technology sectors, investors should take that on board. So I would say if a firm is loss-making, I'm not going to apply any ratio to it because I'm not interested personally. But just be aware that if you try to apply PEs and PEGs in that situation, you'll come unstuck.